Alright, continuing on with problem 3.4b, and we are on transaction G. The transaction is purchased office chairs for $6,500 on credit. So we need some chairs for our office, obviously. So chairs are considered an asset. They are something we could turn into cash if we needed to. So we're going to make a new card, a new account, a T account for office furniture. That will be an asset. So we increase it on the debit side and we decrease it on the credit side. We purchased office chairs for $6,500 and we purchased them on credit. That means we didn't pay the store for them. They're going to send us a bill. But we have to record this in two places, and we're not going to wait until we get that bill. We're going to record it on the day it happened. So we owe people money. That's going to be a liability. So the liability account that we're going to be using is called accounts payable. That's when we, the business owner, owe money to a vendor, or a store in this case. So accounts payable has the increase on the credit side and the decrease on the debit side. Okay, so we know we have the office furniture increasing as an asset on the left, so we're going to have to make the opposite entry on the right hand side of the accounts payable T, and this is increasing the amount that we owe to other people. Okay, so now our accounts payable, into the formula, office furniture and the stack of assets. Moving on to H. H says we received $5,400 from credit clients. That means people that we had performed service for, but they didn't pay that day, have now paid us some money. Okay, so we received some cash, so we're going to be using the cash account, and we're going to be decreasing the amount of money that people owe us. That was accounts receivable. So these are the two accounts involved in item H. So we received $5,400 from credit clients. They should have said we received cash from credit clients. That would have made it easier, but we have to assume a lot of things when we're reading these transactions. So we're going to be adding to our cash account $5,400. And we're going to be reducing the amount of money that people owe us from accounts receivable. So some people have paid their bill. So that will be $5,400 on the right hand side, or the credit side of accounts receivable. Okay, that was item number H. Moving on to I. I says we paid $3,800 to reduce the amount we owed for the office chairs. Perfect. So we paid cash, and we are going to reduce the amount that we owe in accounts payable. Okay, so we paid, let's start with cash. We paid $3,800 out of our checking account, and now we owe $3,800 less, so we're reducing the amount we owe in accounts payable. Okay. Item number J. We issued a check for $1,590 to pay the monthly utility bill. That's going to be easy. We know we're writing a check, so we're going to need our cash account for that. And we haven't paid a utility bill yet, so we'll have to set up a new expense account. So that expense account will be utility expense. Expenses increase on the debit side and decrease on the credit side. We really only ever use the increase side of the expense account. You'll see that as we move forward. Alright, so the expense for the utility bill like I said, I always start with cash because it's easy for me to see quickly if I'm getting cash or paying cash. So we're paying cash, $1,590, and we're adding expenses. Utility expense, $1,590. Okay, put those back in the formula. And on to item K. Item K says we purchased office equipment for $22,800 and we paid half of the amount in cash immediately and the balance due in 30 days. Okay, so this is a three-legged transaction. So we purchased office equipment. I don't know if we've done that yet. I think we've only had office furniture. So we have one more asset to make. So we purchased office equipment. So we're going to need to create another T account, office equipment. So asset. Equipment is probably more like computers and machines. Okay, and then we're going to pay for half of it with cash, so we'll need the cash account. And we're going to pay the rest later, so we're going to need a liability account. Okay, and let's see. We're going to record the entire asset under the asset office equipment, and that is $22,800. Okay, we're going to pay for half of that. So we're going to pay $11,400, and we're going to owe the other $11,400 in under accounts payable. So we made 3 entries, but the left and the right hand sides of the T's equal. Okay, moving on to item L. We issued a check for $18,900 to pay salaries. We need our cash account, and we need to create, a new expense account. Our new expense account is going to be called salaries expense. Okay, and we paid $18,900 for salaries, and we paid with cash $18,900. Okay, put that back under owner's equity, cash back under assets, and moving on to the next page, page 84. Few more to go here. So on page 84, we perform services for $7,450 in cash. When we perform service, we are gaining revenue, and they paid us in cash. These are going to get easy now. Okay, so $7,450, and we received cash. $7,450. Okay. Item N, we perform services for $6,500 on credit. We'll just keep these income here, and we'll put cash away, and we'll grab accounts receivable. Okay, so we perform service for $6,500. And we have clients that now owe us. We'll put that under accounts receivable, $6,500. Okay, item O, we paid $967 for the telephone bill. We'll be using our cash account for that. And we need to make one more expense account then. That telephone expense. And that was $967. And we paid cash. Those back in their spots. On to P, we collected $4,200 on accounts receivable from charged customers. So we're going to need two assets for that. We collected the money, so we're going to be adding to our cash and subtracting from what people owe us. So adding to the cash, $4,200, and subtracting what people owe us, the same amount. Whoops, $4,200. I meant for that to be a comma. Okay, and moving on to Q, we purchased additional office equipment, and we received a bill for $6,880 due in 30 days. The authors say the transactions in a different way all the time, and that's just to help you get used to the different ways that we hear it. So sometimes it's on, we pay on credit, we owe a creditor. In this case, we are getting a bill in 30 days. They usually tell you enough information to figure it out. So we are purchasing more office equipment. I can't remember if that was furniture or equipment. So we need that asset account, and we're going to be paying later, so that's a liability. So we will be pulling out those two accounts. So the office furniture was $6,880. And we owe $6,880 extra dollars. Okay. And R, we paid $900 in cash for gasoline purchased for the automobile during the month. Okay, so we paid cash, and this was automobile expense. So I made a mistake earlier. It should just be auto expense, not repairs. We would use it for both. Okay, so that was $900 in cash that we needed to pay for gas, and that was increasing our auto expense by $900. So auto expense, not the automobile, the asset. And last, Connor McAllister withdrew $8,000 in cash for personal expenses. So we will need a cash account, and we have one last card sitting over here empty, and it's an owner's equity or a capital account. It's the empty orange one there. So I'm going to pull that down and make our last new T account here. And this is Connor McAllister drawing. And that is it's owner's equity. It's a drawing account. It increases on the debit side, and it decreases on the credit side. It's opposite of the capital account as far as increasing and decreasing goes. It is like the counter account for the capital account. We add money into our capital with the capital account, and we take it out with the drawing account. I like to think of drawing like expenses, because both of those things take away from our ending, the end of the month when we're figuring our revenue. I like to think of the fees income and the capital as the same. Those two are kind of the same pot of money. Okay, let's finish this transaction. So Mr. McAllister withdrew $8,000. So he was adding to the amount he withdrew. I should have done this with cash first, because that maybe would have made more sense, because we know we're taking cash out of our business. So when you look at that entry, double check that we have an $8,000 entry on opposite sides of the T. Okay, so now we have completed all of the transactions. And next, we need to total up each T account so that we can prove that our work is in balance before we move into making our financial statements. And to prove that, we use a trial balance.